Hello, everyone. This is Professor Howard Eskew, and this is video 2 for Chapter 1, Introduction to Financial Statements. So in this video, you should be able to, once finished viewing it, describe the content and purpose of each of the financial statements and explain the meaning of assets, liabilities, and stockholders' equity, and then state the basic accounting equation. So let's start with the financial statements. A financial statement is the means by which companies communicate their financial information to various users. As we learned in the first video, there are two groups of users, internal users and external users. There are four basic financial statements that all companies utilize. They are the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. Let's first look at an income statement. As you can see on the screen, for Sierra Corporation, this is their income statement for the month ending October 31st, 2014. In the income statement, you can see that it is for a specific period of time. An income statement is cumulative. That means the data is gathered throughout the period in which the statement is made for, and we just continue to gather the financial data through that period and then prepare our financial statement. If you look at the income statement, it has a header. All financial statements have a header. The header goes in this order: the company name, the name of the income statement or the financial statement, in this case an income statement, and for the period. Next, you'll see that it's revenues, expenses. We subtract expenses from revenues and we get either a net income in the case where revenues are greater than expenses, or a net loss when expenses exceed income. Once we have our income statement completed, we can move on to our statement of retained earnings. The reason we need to do the income statement or prepare the income statement first is we need that income number in order to prepare the retained earnings statement. What we mean by retained earnings is retained means save or keep back. Earnings represents profitability. So retained earnings is that amount of profitability that a company retains within itself in order to operate its company. Again, this statement of retained earnings is a financial statement, therefore we have a header, but we only generally have 4, maybe sometimes more lines. We have the beginning balance of retained earnings, so the amount of retained earnings that was in the company at the beginning of the period. In this case, it shows that we have 0, which means the company must just have started its operations in October 1st. Then we add any net income. We add those two together, and then we subtract any amounts of dividends or any amount of profitability that we're going to share with our stockholders. We subtract that out, and what we're left with is the amount of earnings that is kept by the company for its operations, or ending retained earnings at the end of the period. The value of a retained earnings statement is that it shows what has occurred in our profitability for the month. Off the balance sheet, we have a retained earnings number, and we take that retained earnings number from our retained earnings statement, the ending balance, and we move it to our balance sheet. Our balance sheet is known as a statement of condition. Notice on our balance sheet, we have a heading, the company, the name of the financial statement, and notice it's for a particular date. A balance sheet is a snapshot or a photo of the position of the company on a specific date. That balance sheet's information is good only for that date. If you notice, we divide the balance sheet up into three parts. Assets. Assets represent what a company or organization has. Liabilities. Liabilities represent what a company owes. And stockholders' equity, also called owner's equity, represents that value of assets that the company owns. So assets are what a company has. Liabilities are what they owe. Equity is what they own. Notice we first show assets, and we show them in order of liquidity. The term liquidity means how quickly can I turn the asset itself into cash. So those things that are most liquid are listed first, and we go down the line through until we get to the least liquid assets. Once we have them all, we total it and get total assets. Then we do liabilities. We also do liabilities in the form of liquidity, meaning those liabilities or debts that are paid the most current or come due in the most recent period are listed first, and those that we pay over time on a longer period or basis are listed lower. Notice we add all of our liabilities and we have total liabilities. Then we have stockholders' equity. Stockholders' equity shows the amount of stock that we've sold, or another term for sold is issued. And we also have our line for retained earnings that came from our retained earnings statement. We add all of our equity items together and we have total stockholders' equity. So notice in a balance sheet that total assets equal total liabilities plus total owner's equity. And if you look at total assets and total liabilities and owner's equity, they equal. We call it a balance sheet because assets must equal liabilities plus owner's equity in order for the balance sheet to be in balance. There is our formula. Assets equals liabilities plus owner's equity. We also call that the accounting equation. Once we have our balance sheet, we can take our cash balance, and that ending cash balance, when we create our statement of cash flows, must equal the ending cash balance on the statement of cash flows. Statement of cash flows also has a heading. It's also for a period, but notice it's broken into three parts. Those three business activities. There is the operating activities, the investing activities, and the financing activities. This statement shows us where all of the cash is coming in to the company or cash inflows, and where the cash is leaving the company or cash outflows. We will talk more about the cash flow statement later in this course. So the interrelationship between the financial statements simply tells you the order in which they must be prepared. So we must do the income statement first to get net income. Net income moves into the retained earnings statement. The retained earnings statement, the ending retained earnings goes into the balance sheet. And once we have our cash balance, we balance that to the statement of cash flow. Let's look at some review questions for the accounting equation. Remember, if assets equals liabilities plus owner's equity. In this question, it says John Deere Company has $2,000 in assets and $750 in owner's equity. How much is there in liabilities? Hopefully you said $1,250. If we use the equation, assets were $2,000, owner's equity was $750, so we simply solve for liabilities. Here's another one. As of December 31st, 2013, Powell Popcorn Corporation has assets of $3,500 and liabilities of $1,500. What is the owner's equity? We put in what we know, and we know assets and liabilities. We solve for owner's equity, which is D, 2,000. Are you getting the hang of it? Let's do one last one. As of December 31st, Powell Popcorn Company has sales revenues of $75,000, sales expenses and rent expense of $10,000. Now we're solving for net income. If you remember the income statement, it's revenues minus expenses. Our revenues are $75,000. Our expenses are $20,000 and $10,000. So if we take 75 minus 20 minus the 10,000, then our net income is 45,000. So in this video, we've talked to you about the content and purpose of the 4 financial statements: the income statement, the statement of retained earnings, the balance sheet, and cash flow statement. We've also showed you the basic accounting equation of assets equals liabilities plus owner's equity, and we've given you examples to demonstrate that assets equals liabilities and owner's equity. In order for the balance sheet to balance, those have to be true. This is the end of this video, and we hope that you get a better understanding of it. We'll see you in video 3.